ImpactAssets is a nonprofit financial services firm focused on increasing the flow of capital to impact investing through field building and innovative product development. On the product development side, we run a $250 million donor-advised fund that is invested across asset classes, from the public markets to the private markets and real assets, so across the asset class spectrum. We also are bringing to market two impact securities, one focused on microfinance and the other focused on global sustainable agriculture. These products are designed to democratize access to impact investing by lowering investment minimums. So our goal for 2016 at ImpactAssets is to scale the donor-advised fund, continue to be state-of-the-art, super creative, super innovative in the donor-advised fund field, to deepen our impact through continuing to allocate to innovative public mutual funds and private debt and equity funds, as well as individual deals. The products, as I mentioned, are coming to market in Q4 of 2015. So in 2016, we're excited to deploy capital by lending investment capital to microfinance institutions and agricultural grower cooperatives and production operations as we seek to move the dial on livelihoods for the rural poor. As I mentioned earlier, we're bringing to market a microfinance plus note and a global sustainable agriculture note. Typically, to gain access to private debt and equity fund managers, you need to stroke a check of $250,000, $500,000, or even more. And you need to be an accredited investor, or even a qualified investor or qualified purchaser. And that's outside the reach of many investors, both retail and high net worth, as well as institutions. And so these products are designed to increase the flow of capital to impact investing by lowering minimums, so they're literally an on-ramp into impact investing on a thematic basis for a broader range of investors. We've talked a lot at SOCAP and generally in the field over the last year about the mainstreaming of impact investing. And that is happening both for high net worth individuals and institutions, as well as retail investors. We see some interesting market entrants, including BlackRock entering the field with an impact investing initiative. We see Bain Capital also entering the market, potentially with a private equity investment fund. We also see wealth advisor incumbents like JP Morgan, Morgan Stanley, and the like, Merrill Lynch, BNY Mellon, entering the market in part because clients are asking for impact investing solutions. And so those incumbents are starting different kinds of strategies. They've taken either a buy or build approach. For the most part, the incumbents have built various solutions from within, but most notably and most recently, Goldman Sachs purchased Imprint Capital, which was a pure play impact investing registered investment advisor. And so we really see that acquisition as a signal to the field that the incumbent players are taking the trend and the movement of impact investing really seriously. We're also at ImpactAssets very interested in the democratization of impact investing to the average investor. And there, I've actually written a piece in Conscious Company magazine called Impact Investing for the Rest of Us that talks about how retail investors can get exposure to impact through cash, through the public markets, through mutual funds and ETFs, and then there are select private offerings available in the market, including our coming investment vehicles, the Community Investment Note of Calvert Foundation, and a few others that will enable the average investor to get exposure to impact investing. In impact investing, we are seeing the development of tools and techniques by which to measure not only financial returns, but also impact returns. On the financial side, we're starting to see fund managers who are bringing to market second, third, fourth vintage funds. From their earlier funds, we're starting to see reported returns, financial returns. Cambridge Associates and the GIN this year launched something called the Impact benchmark, which looks at market rate impact venture capital firms and compares it to the non-impact Cambridge Associates benchmark. And for certain types of vintages, for smaller funds, for emerging market funds, and interestingly for funds focused on Africa, it seems that the impact investing venture firms actually outperform their incumbent the incumbent examples. So that is on the financial side. On the impact side, we continue to see a rising bar for metrics, measurement, and reporting. The IRIS standard, which is a taxonomy of metrics, is the incumbent tool to use. And we start seeing companies as well as fund managers bringing an increasing level of discipline to measuring those metrics and reporting those metrics for a variety of stakeholders. We've talked about the mainstreaming of impact investing for both high net worth individuals, institutions, and also retail investors. One of the things that we'll be looking for in the coming year and beyond is, as we mainstream, we continue to bring not only the discipline of the financial capital markets, but also commensurate discipline around quantifying impact, stating impact, and delivering impact. According to the 2014 report from US SIF, there's $6.5 trillion invested with impact in the United States. That's 1 in 6 of all investment dollars. And that is impact investing across asset classes. For investing in private debt and equity, or what we call deep impact, it's more like $60 to $100 billion. It's small, but it's growing, and it's growing globally. The growth of impact investing is driven by a couple of different factors. One is simply a set of social, environmental, demographic, regulatory driving forces. We have 7.5 billion people on the planet. Demographers suggest we will have 9 billion by 2050. How will we feed them? How will we clothe them? There's increasing demand commensurate with that growth. And most of that growth will happen in emerging markets. We also have increasing demand for clean water, fresh food. We have commensurate public health challenges. And then on the environmental side, we see increasing evidence and direct personal observation of climate change. We have a drought in California and in many other places in the world. And so there are these set of driving forces that are creating an imperative to align our investment portfolios consistently and at least not at cross purposes with our values. We also see a coming wealth transfer of $30 to $40 trillion over the next 30 years. Wealth will be transferred from the baby boomers to women and millennials. And 3/4 of both of those cohorts we know are interested in investing according to their values. And so we see this coming development on the supply of capital side, meaning folks wanting to invest consistently with their values. And then on the driving forces side, we see an increasing need for for-profit solutions to private sector problems. And so at the intersection of the increasing supply of capital, increasing demand for capital, we see an exponential growth for impact investing.